money you manage for your investors, and I know a lot of your money is tied into your fund as well. I know there's that incentive to be always in the market. That the institutional imperative of making sure that you are in the market and delivering. Do you see any difference with not money wealth also in your fund, but money outside of your fund where maybe you're okay to hold in cash for a little while if you think things are maybe it's very hard where you have to dig into the weeds to really find something? Are you
I think,
okay?
yeah, it's so my father constantly wants me to hold more cash, both in the fund and outside of the fund, than I do hold. And I think that the question, the way I'd put it back to you or the person asking that question, and I do ask this because I get this question asked this question by investors, I get asked this question by people who are about to send me more money, is if you're a buy hold and hold investor and you buy Amazon and it's gone up 10 times, now do you sell some of Amazon to keep the level of cash as a proportion of your portfolio? Or do you just say, well, I had enough cash then, and yeah, Amazon has gone up 10 times, but I'm still going to have, I'm not going to do it in proportion to the size of the portfolio. I'm going to do it in proportion to what I feel I need. I don't know if that makes any sense to you. I think that maybe another way of putting it is that I think that if you become a buy and hold investor, that question kind of goes away, because you're just saying, imagine you buy a property well, you're in Toronto, so you buy a property and you've done really well and the value of property is tripled. Now, do you say, I put $1 million Canadian dollars into the property, it's now worth 3 million Canadian dollars. So now I got to somehow sell 10% of the new updated value and try and keep that new updated value. I think at some point you just give up and you say, I'm glad the value of the property's gone up and I'm going to look to see that I can meet my cash needs for a few years if that were to happen. But I'm not going to worry so much about the levels of cash relative to the value of the portfolio. I don't know, is that helpful, Jeremy?
Yeah. And so I know, I know it's foolish to ever think about even timing a market crash or anything like that. But do you ever look at any of those aspects where you see Warren Buffett in hordes of cash and you see, okay, we've been on a level of prosperity for so long that maybe it can't last. Do you ever tap into those emotions in aspect of the cash and maybe think about maybe there is a storm coming soon and it would be okay to have XYZ in cash?
So yeah, let's see if I can give you a good answer to this. Let's be clear. I don't think that Warren has ever sold significant portion of any of his long-term holdings. So he hasn't sold a significant portion of Coca-Cola, certainly hasn't sold any of the private businesses that Berkshire Hathaway owns. He's not adjusting his portfolio based on those valuations. And I think that in retrospect, he's kind of said with Coca-Cola that it got so overvalued at some point that he probably should have sold some. But I think that he was probably just saying that to appease people who kept on asking him the question. I don't think he ended, even if he'd have known, if he could go back to the period when it was so overvalued, he still wouldn't have done it. And so I'm blanking out a little bit, but it's just, I think that it's because I just cannot. I think that once you start investing, this feeling of being afraid of a market crash, perhaps not right away, but after you've been compounding for a few years. So when you start at 100 and 100 goes to 120 and it might go back to 90 and you might be below what you originally invested, that becomes a fear for you. But once 100's turned into 200 and 200's turned into 400, and now maybe 400 might go back to 300 again, but you're still 3x what you originally invested. I don't think that those fears around whether the market is right or not, what's going to happen short term to the market impact as much. So that's
Mm.
just a perspective change that happens when you are way into it. Um, yeah, I don't know. I don't think I
Yeah.
answered the question very well, Jeremy.
Well, and I know Warren. I don't know if it was Warren or Charlie said, expect your portfolio to slash in half 3 times in your lifetime. So I definitely understand that aspect of, um, waiting out markets, no matter what they're doing, and you buy great businesses. But for a lot of people, and I know for myself, where as you're piling up cash and capital, and a lot of people are now starting to save money, it can be hard to know, do you actually enter the market,
Yeah, and
or do
maybe
you
so
wait?
um, another way of slicing the cake or looking through the prism is don't what you're actually doing in making that decision is that you're not trying to be the smartest guy on the planet, and you're not trying to time the market. What you're trying to do is to manage your own psychology. So actually, what you want to do is do the thing that you're going to be able to consistently follow through on. And I think that in the past, I've been very fearful of selling something I think might be overvalued. Not because I fear more the danger of interfering with my portfolio too much. And if I start trimming positions that have gone up a lot, trading around positions, that's going to create a habit or going to create a reason why I can do it again. And before I know it, I'm going to be trading in and out of stuff the whole time and damaging this idea of just buying into the portfolio and holding it for a long time. And so I think that perhaps the way for you or somebody else who's fearful or concerned about the market being toppy, let's say, is to say, I know that commitment to equities is the right thing, but where my psychology is that I'm feeling nervous that the market is toppy, or I'm feeling nervous that nuclear war might break out, or I'm feeling nervous that Donald Trump has just been elected president, or that Joe Biden has just been elected president, or that Russia's going to invade into the Ukraine. And so to say to oneself, how do I invest in such a way that even if my worst fears come true, I'm going to be comfortable with what I did and I'm not going to seek to change my mind or adjust. So if I invest 100% of my portfolio and then Russia invades the Ukraine and equity markets are down 50%, is that going to hit me in the gut and make me so sleepless that I'm going to want to sell again? And so if that's the case, maybe I shouldn't do 100%. Maybe I should only do 50% or 25% or 5% or zero. So, but I would tell you that, so think of it of managing your psychology. I don't think that the best decisions I've made don't feel like I'm diving into the unknown. They don't, so investing, buying something, stepping from that certainty of cash into the ownership of something whose value can bounce around is never easy. It's kind of like taking the dip. It's like jumping into the cold water, but you don't have to dive headfirst into water that you don't know how deep it is. So you can dip your toe in, you can dip your foot in, you can go slowly, and maybe that's a better way to look at it.
Hmm.
And I think that what's really valuable about investing is that you can open up a trading account at Charles Schwab is what I like, and buy one share. There's a statement that says the stock doesn't know that you own it. Or another level, you don't know the company until you've owned the shares. Somehow there's something that happens when you own the shares that's different. And so, if you were planning to put $1,000 in something, put 100, and now look and see how you feel. I found it interesting that I bought shares of a company, I don't own it anymore, called Jordan Phosphates in Jordan of all places. And then of course the price quotation goes down by like 50% because that's what always happens when I buy something. But I was not compelled to buy more because I found myself focusing a lot on the fact that Al Qaeda was in Jordan, and actually Jordan is not a developed country. It's not even a developing country. It's what I think you would call a frontier market. And so I bought some and then held my breath and kind of watched it and felt like I wanted to put more money into some other things. So you're also not forced to make an all or nothing decision. You can take a step, see where it is, take another step. Is
Mm,
that helpful?
very, yeah. Very helpful, especially the part of, yeah, mastering the psychology, I guess, of putting in, dipping your toe in with a bit of capital so that you truly, I guess, you feel the emotions of owning that capital, which then makes
Yeah.
you dive deeper into that business to begin with.
It's
Um,
it's the theme that's in my book, that actually the best journeys in investing are journeys into knowing ourselves, finding out who we are. And actually, don't worry about being smart, don't worry about timing the market, find out who you are, and
mm,
and become the best you can be in that situation, which is being able to say, I, have the long-term goals be clear. The clear is to make a lot of money by staying committed to equities, because we know that that's where the returns are. But it's doing it in a way that's consistent with your own personality, with your own shortcomings. And I would tell you that another thing that we haven't talked about is that forget about your own psychology, or don't underestimate the degree to which your own psychology is influenced by things like, have you paid off your student loans? Have you paid off your mortgage? Is your mortgage in a place where you're extremely comfortable? If things got bad, you'd be able to cover your mortgage by covering your sports club membership. Whereas your mortgage just like sort of up to here, and you're like any slight bump in your income, you could be in dire straits on repossession of your home. I think that don't underestimate all of those things in affecting your psychology. And I think that it's very hard to be a good long-term investor if you haven't got all those things nailed. And that includes, having good health care, having good insurance, having some cash aside for a rainy day, having owning your home. And if you don't have all of those things nailed, then you have to be very careful about how you tread into equities.
mm,
So all of that, I think a lot of the time when we see somebody who appears to have a very different psychology to our own, it may not be that different. It's just maybe that their financial circumstances are very different. And, I don't think that you're married, but different people get into different marriages. Some people get into a marriage where the spouse doesn't want to own any material possessions and just wants to travel, which may be more conducive to getting committed to equities long term if you're the other half of that partnership. And another marriage, the spouse absolutely doesn't want to, she doesn't, the partner, I shouldn't say he or she, because you don't know, it could be two males or two females, and we don't want to be judgmental. But the other side of that partnership may say, well, we're not done with our quality of life until we own 3 homes, and we travel, we travel first class wherever we go. And so if you have that kind of lifestyle that you need to keep up, then you're going to have to kind of make sure that you're fully covering that lifestyle with your income before you start making a commitment to equities. So all of getting those things straight. Some people have very simple hobbies and habits. Some people have very expensive hobbies and habits. If you're borrowing money to fund your hobby of, let's say, flying private jets, and some people, they love flying airplanes, and airplanes are damned expensive, or some people love boats, then you better have that covered. You don't like borrow against your equity portfolio in order to cover the cost of your yacht, because you'll end up. Um, so, I think that also, for what it's worth, Jeremy, and I think that maybe I said this to you before, I've said it elsewhere before, but it's just come up for me increasingly, is that people say, oh yeah, I committed 100% to this wild flyer of an investment. But actually they committed 100% of the 5% of their portfolio that they keep for wildflower investments, and actually they got 95% of their net worth is in T-bills. So you never really know how people are invested and what proportion of their portfolio they committed to something. So I think the point is, don't look at other people's behavior and let it determine your own, and let it feel like it's judging what you do. Do what's right for you.